Hey guys, it's May from Markets with May, and today we're going to actually talk about the energy sector and Kinder Morgan, which just kicked off the earnings season for oil and gas. And it's kind of a very, very nuanced, exciting thing that I think really becomes one of the single most important macroeconomic aspects to watch because really it's the energy sector that is going to either help, hurt, make, or break. And what I'm gonna do is I'm gonna go through. Hey, I'm going to go through CPI to really explain why the energy sector is going to become increasingly important, where certain types of arguments lie, and why I don't feel comfortable being as bullish. And I've mentioned it in other calls, but I want to just really clarify it in this call. But I'm not as comfortable as others are in being super bullish a recovery, at least specifically the time horizon on the recovery. So let me go ahead and share that out first, and hopefully this is helpful just across every sector and every way that people are looking at it. So first, what's going on with energy equities? When are they reporting earnings? I know some of you are putting questions in the hopper there. That's awesome. I'm going to go through this. It's probably only about 10 minutes or so, and then I'll start answering questions. But this is what the energy's earnings calendar looks like for S&P 500 only names. And yesterday we had Kinder Morgan report. They are a pipeline with a few refining components attached to it, and they really usually have good color to give you a broader picture of what's going on. But I'll show you what I saw. Do I like Kinder Morgan? Yeah, he's not going to have any problem paying that dividend yield. And in general, this sector should not, given what I heard yesterday, have any problem paying their dividend yields. And because of this other dynamic that's going on between energy prices and energy equities, you get this, you do actually get some really sizable dividend yields that should last for some time. So that was absolutely clear from the Kinder Morgan call, but the other pieces that I really need to see to start getting bullish on the economy were not there. And so I have to almost backtrack a step to last week's CPI numbers because I've mentioned this a few times. I do just want to show it. This is what CPI looked like last week. We had finally a little bit of a reprieve on inflation with a down 0.1 metric, and everybody got super excited. The market rallied off of it, and I was like, ooh, I don't know. I don't love the mix of this. And what it was that I saw that made me not love the mix is that a lot of the removal came from just two spots. It came from energy and it came from used cars and trucks. And yes, there's actually several hundred different entries when you break down CPI aggressively. But those two areas were like massively standout. And really, within the X food and energy component, used cars and new cars is such a big piece that it almost outsides. It has an outsized effect on CPI. The other outsized piece is really housing, which went up quite significantly. So a lot of people don't look at the special aggregate indices that comes in the appendix portion of CPI. I'm a nerd. I share that with you guys. And this is what you'll see if you go through it. If you took, less food and energy, some people thought that that's a wash. Okay. But in fact, if you just take out the energy component, just to give you a sense for how strong the food component is, on inflation, there you go. So if you take the energy component out, you do actually have an up 0.2 number in the release. Now, the people that are very excited about what the inflation numbers are going to look like, and therefore staking their flag in the ground on what the Fed's going to do, are seeing this. And I got to hand it to them. I can't deny this. This is true. This is where energy prices were last year. And because of the conflict in Europe, you saw a huge spike in February. But realizing that even in November, we had already released reserves pre-conflict. So an $80 price, and that's part of the reason why when oil dips below 80, I'm just like, this is ridiculous a little bit, because this actually was the first time we released reserves. It was not this was the first time. Just FYI, definitely worth double checking anyone that is saying otherwise. And then we ran up into it as the conflict approached, and then a huge spike up to around 115, I believe, on the crude contracts at that time. This is the February, but they usually roll the strip backwards so that you have an actual chart. And then it got as high as 120 ahead of summer. Okay, so yes, with oil currently at $80, it's looking okay for inflation. That these numbers that comprise CPI will continue to be cosmetically looking a particular way. One of the other things, though, that's allowed you to keep CPI there is because we've had a milder winter in Europe. And whether or not that persists is really just Mother Nature. So that's always very tough. Okay, but then why is it not so obvious then? Like, why is it so hard for you, May, mentally to get really excited about the economy and where it goes and that rates are going to decline, et cetera? It has to do with that CPI number, but it also has to do with this. Now, this information came off the Dallas Fed implied change in world oil stocks. And what I think my issue is that the drawdown from COVID, even though people are like, well, we didn't use as much oil, kind of, but we drew down so much oil from a global perspective. This is what actually happened. These first two quarters of last year represent the fact that it actually takes time to ramp up energy production. And so you really don't get any kind of restocking until the latter part of the year globally. And then these are the projections to try to compensate for this. Realize that we're still releasing oil in order to keep oil prices a certain way. So when I'm saying, hey, I really can't tell if oil is being gamed or not, that's what I'm referring to. Now, also, I want you to realize as well that it is very, very hard to know if the energy companies, what strategy they're going to take for several reasons. First of all, anyone that's actually got data on this, that's amazing, because like the official data is delayed by 2 years. Like if you go to the IEA website, you're going to get the 2021 production numbers, but they'll always post it like it's 2023. It's just not true. These were the production numbers. We were a little bit shy, 95 million barrels globally. We were shy of 2019 by about 10 million barrels. And it's really the US that probably this number is probably accurate even for this year, because 2021 still represents the past production crunch. So we're probably somewhere around 19 million barrels, what have you. But realize that we're not always, like right now, we're definitely an exporter. But if you gave us the chance and you open up this economy, there have absolutely been periods where we use every barrel that we produce. And so if you're going to start expanding the US, you got to kind of really be careful there. So this is 2016. At that time, we were still producing around 14 million barrels, and we were using 18 or 19 million barrels, just to give you a sense for what the numbers and the magnitudes look like. Right now, I think we're somewhere around 16 on some estimates, and we're producing about 18, hence we're net exporting. Okay, one of the things that bothered me since last quarter, the only data points that people would publicly get would be data points that came off of thanks for the heads up on the SPY. We got an inverted head and shoulders there in case anyone needs to do some stuff. But since the last quarter's earnings report, the only real thing is there have been like one or two energy conferences, and most of the CEOs have indicated that they refuse to produce crazy amounts of oil and gas. And the reason that they refused to produce it is because of what they're seeing in the forward strip. In other words, they can't hedge it out. Now, let me just show you really briefly what it looks like on the forward strips so you can kind of take a look at that. And you can get this data off of the CME. They absolutely, because it's really hard to see the calendar if you're just trying to find a chart unless you've got like advanced stuff like a Bloomberg that you can look at. But here's what this strip looks like. Nat gas has actually gone into contango. So it absolutely is easy for you right now to make more nat gas and sell it into the marketplace, because you can hedge it out higher, or you can pre-sell it there, make it. And then because this is a physical delivery contract, you're good. Okay. The Brent contract is not physical delivery, it's cash. And right now it's trading flat all the way out to September before you get any kind of, and then you've got backwardation. So that, not helpful for hedging. A little bit helpful because if you're in the US, you'll make it well below $80, but outside of the US, there are absolutely countries that need the price to be like at least 70 plus. But even then, you're really, unless you feel strongly about the production number, it's not ideal for hedging it out. Similarly, the CL contract, which is a physical delivery contract, it actually goes in contango farther back. My calendar is about the same, so it's, if I move this, yeah, so it's about September again. You have a drop off, so it's not ideal for trying to hedge out anything further. And remember that your classic number that people throw out for increasing oil production is about six months before you start to really be able to get a sense for bringing that capacity online. Okay, so the U.S. rig count, I know that we've increased oil production, but just so you can see it relative to past periods, the rig count has not increased over the 2019 period, but crude oil production has increased. That is a testament to where the oil is coming from and precisely what's going on there. OPEC has increased oil production a touch, but not to 2019 levels. And then here we can see the inventories. This comes from the IEP, so it is accurate through December. You can see the inventories are still slightly below where the gray band is the average range over the last 4 or 5 years or so. And you can still see that we're very low on distillate and nat gas inventories. And so it gives you this picture that you're kind of like, I don't know what to think. What would they do? Especially if at the conferences, people are just saying, hey, if we can't hedge it, we're not doing it, so to speak. And now I just kind of want to show you, here's the shut-in prices, because a lot of times you see when people say the US is a low-cost producer, there's two ways to look at it. You can look at shut-in prices, which is just what covers their operating expenses, or you could look at profitability, break even on the project itself. But you can see that for us, pretty much the shut-in prices are quite low. So that is actually not the case for other parts of the world. For other parts of the world, their shut-in prices can be as high as $60. And then depending on how they're taking the oil out. And then here is what do you need the WTI oil price to get to for you to profitably drill a new well? You can see that primarily we're going to draw down, if anything, when I listen to what people are saying, they're not going to, even though, yes, this is the price, okay, they're not going to do this stupidly because it is still a non-renewable resource. And so if they feel like the forward strip is showing a number that is only going to barely eke out pass over the break even, but they think that in fact there's still a shortage and a shortfall given how much of a percentage Russian oil supply indicates, then they're probably not going to make it. Because again, remember, this is what the back end of the curve looks like. This is out to June of 2024. But even here, we start to see a pretty fast collapse. So for me, I really need to hear clarity on the strategy of all the energy companies they're going to report. I'm going to go through Kinder Morgan in just a second, but just as an overview for timing of how that news flow will come out, we have Schlumberger on Friday. They're more in the oil and equipment side of things, and also in particular, since they have a lot of the projects that are going on in Egypt and the North African areas, you'll get a sense for whether or not Europe will have another source, for lack of a better way to describe it, than just taking all our oil and gas, for lack of a better way to say it. And certainly, since most of their oil and gas from last year was bought, but in fairness, from Russia before they really finished off the embargo, they will run that down, and then we shall see where the oil and gas production numbers are so they can re-up their storage facilities. Or alternatively, we'll see what's announced in the mix, if more mix was brought on, if there was any additional drilling E&P activity in the North Sea that helps them out. But I'm not loving the picture in Europe, and I therefore have a difficulty understanding what that implies, since oil trades on the global scale. It's not just what we do here in the U.S. Okay, and then so the first three companies that come out are Schlumberger, Baker Hughes, and Halliburton. The issue that you have is Baker Hughes, because it is a GE special, for lack of a way of describing it, it still has a bunch of extra mess every quarter in its numbers. And so people sometimes think that it should be a canary in the coal mine, but because they have a lot of special sauce, so to speak, it never is. I'll just say it that way. And then Halliburton and Schlumberger usually are pretty good at telling you on the macro front what they're seeing. And then we have our first E&P company, Hess. Since Hess is not onshore, it can give you a really good sense for what to think about Europe and what they're seeing and how they're thinking about it. And then from there, we'll kind of be off into the races with a lot of the other companies starting to report. The one that I'm probably the most intrigued by is Coterra. Most of their assets are in the Eagle Ford, West Texas area. I believe that's correct. Yeah, they have some in Eagle Ford and they've got a bunch in West Texas, but they are now giving you a 10% dividend yield. But let's get back to Kinder Morgan. And just for the record, in case it's unclear, past performance not indicative of future returns. I do actually have positions, obviously, in Coterra because I like the dividend yield, and I've owned Kinder Morgan forever because Rich Kinder is just such an intriguing person that I think is great. Additionally, by the way, because there has been legislation for anyone watching this that's one of my European folks, there is this weird tax legislation that I've been asked about more than once as relates to the MLP structure. And so many pipelines are an MLP structure, as well as so many of our oil and gas companies are structured as master limited partnership. And because of what's happened on taxation, I know a lot of you guys are like, oh, I got to punt this because it's not worth it anymore given the taxation component of it. Kinder Morgan is not an MLP. At one point, Rich Kinder did actually structure it as Kinder Morgan Partners as an LP, but that's long since gone. He bought back that in entirety. So KMI should not be beholden to the master limited partnership issues, but should look a lot like those businesses in case you're looking for a replacement. Currently, its dividend yield is around 6%. And I tell you, I don't think he's going to have any problems paying it. He is well below any number. And if anything, he's probably more looking at stock buyback. Little bit of history on Kinder Morgan for the folks that like to just get started in these names and do their own rich research. Mr. Kinder comes from actually Enron. He was early days Enron, and he was the president and COO, Chief Operating Officer of Enron until 1996. So he was nowhere near the hot mess that became Enron in 2001, I believe, when it blew up in a blaze of glory. And had all those special things. Nonetheless, Mr. Kinder is extremely highly regarded in the energy business. And if, in case anyone from that business is listening, they did just promote to CEO Kim Dang. I'm super excited because she is both a Northwestern alum with Wildcats, and also I really admired her like crazy whenever she's just so amazing. Every time I hear her on the call, I wish I could be her in some ways because she's got like literally every number memorized. So I do think that is a really good person to come in. The other thing that I think is always really attractive about this company from a shareholder perspective is that they are not paid a salary. I think $1 is what they're paid in salary. They actually make money off the dividend and appreciation of the capital base. So they're a very interesting one for anyone to do research on or to learn about for that reason. And then you decide whether or not it's an interesting one to add. It is not one that I trade around, quite frankly, because I feel like the dividend is so stable. And from the work that I did on it years ago, and then what I've maintained on it, I feel good about just their ability to produce income for me. So I own it much lower. So my return on that base capital looks better. So that we'll do as another video at some point. But KMI is a very interesting one that clearly is not going to have problems. The only thing that it sometimes has from time to time that can create opportunities is because the location of their pipes is in that Texas area, and we've been having crazy weather in the Texas area. From last year, they had a few charges, both related to hurricanes and related to the freeze that went through that Texas area because, pipes, if they're not provisioned past a certain level, do certain things. They swear that all of that CapEx is done at this point. I actually believe them. I don't think they have any kind of reason to lie to us on that. And we definitely saw them in the last cold period doing just fine. But like I said, due diligence is everything. This is more what I wanted to talk about with Kinder Morgan is just to demonstrate that things are actually still pretty good. Top line growth of 3.4%, very boring, but business as usual sort of stuff. Net income of 5.1% means that you are seeing some of those old problems from last year go away, which is great. And then this is usually what I look to as an early indicator of what in the world is going on in oil and gas as relates to volume. And I got to tell you, I get nothing from it, which makes me unhappy because I was really hoping for something really exciting to say. But I do get that in general, the volumes are good. So some people might think, oh, the volumes are down because of economics and because of the warmer weather. That would not be true, or would be very hard to get a sense for, given where the Kinder Morgan pipelines, transportation centers is, and their whole complex of storage. So there, you might have thought it would have been the case because you've got pipelines, first of all, doing better than expected. That means more oil is going through the pipe. Sales volumes down a touch. It just means probably that people were waiting a half a beat to buy the oil at different prices. Gathering volumes actually up. That's oil coming off the wellhead. So that actually looks slightly better, not crazy astronomically better, but definitely better. And then NGLs sold, that's your liquefied natural gas, is actually a bit higher. And then the pricing you got was higher for them, the realized weighted down here below. So to me, it looks like even though delivery volumes looked flat, it's still looking pretty good for the first quarter just from Kinder Morgan, but it's not so wildly amazing that it's easy for me to just be like, this was awesome, all of oil and gas will rally. So we're still kind of left in this spot of not knowing and not being able to tell the degree to which people up their oil supplies. We won't get that until we hear from maybe Schlumberger, and we'll get some sense for what's going on in North Africa. And then I kind of need to hear from Hess. Hess has operations all through the Atlantic. So that's where we're at, unfortunately, which means it's going to be quite a wild ride. And with that, I will end that portion and take questions. That went a little longer than I expected. Hey, David.
Hey, May. We have a supply demand imbalance. So
that's my concern.
Okay.
Yeah. That's really my concern.
I had my first responder golf show, remember?
What's that? Oh yeah, that's great. Yeah.
Right.
Do they have a conference date? They have a conference date for that nonprofit yet?
Not yet.
Okay.
No,
well, we'll be trying to promote that because the firemen deserve to, have support as far as that goes.
Yep. 3,900 on the S&P is a very important level.
Yeah. Okay, let's see if we got any comments. Were there any questions? Thoughts on EQT? The REIT? I don't know, Pat, if this is what you're talking about. It's interesting. I don't have any. Let me prepare something for next show because I don't have strong thoughts on it. They probably got their rents through. And gosh, it's really interesting. I mean, you definitely have rental prices increasing. Let me look at my notes from last quarter because they, in particular, if I remember correctly, from last quarter, so what had been actually helping a lot of the apartment REIT type companies throughout the pandemic was really the fact that the wealthy folks were still getting paid, for lack of a better way to describe it. And in particular, the apartment REITs, Avalon Bay, and I think Equitable is an apartment REIT, if I remember correctly. They you didn't have the layoffs, for lack of a better way to describe it. And so, now with the layoffs, I believe most of the apartment REITs tried to spin it on the last call that they didn't have as much exposure to tech as everybody would have them believe they do, that they had a wealth of different sources for rental income. The problem that I have with that argument is that, if Seattle starts laying off a bunch of people, it trickles down pretty aggressively. Now, will it trickle down in 1 quarter or 2 quarters? I don't know the answer to that. These are such well-paid people that they'll probably continue to pay their rent. Add to that the fact that people are moving away from these locations. Oh, EQT Corp. I'm sorry, I thought you were asking me equitable to
It's a
read. You know what?
it's a gas.
I don't know EQT very well because I only really primarily watch the S&P 500 names. But what I would say is that if it's in the Eagleford area, if most of their if they're okay, so if they're an E&P company in the Eagleford area, I think they'll do really well. Murphy Oil has about 30% of its exposure in that region, so that's part of the reason why I'll go down cap to them, but I don't know all the smaller names within the space very well. The pipeline should do just
EOG. EOG, remember?
EOG should do great. EOG
Okay.
is one of the lowest cost producers.
Okay. That's a gas.
Yeah,
Right.
yeah. EOG should do great because it's mostly Eagleford, West Texas. I mean, they are really. I mean, they are definitely okay. So let me show this slide again because if you guys want to look,
Permian Basin. That's
yeah,
Permian Basin. That's where I'm from.
is it really?
Yeah.
So yeah. So this is what the here. So the shut-in prices for the wells is this, and then the Permian Basin is this. And what you'll look for if it's not a name that I cover and I don't know, okay, if it's Permian Basin, it probably should do just fine because the demand looks like it's there, and also you're well above the pricing, even with the craziness that we've been getting. Because I do think that the beauty of all of the oil and gas companies
Hello.
is there's no that work that business at all whatsoever. All of them will
Hey,
actively
Tanya.
Hey, David, sorry. All of them will actively hedge, and they will actively hedge well in advance, and then they will not do stupid hedging. It's just, I really do believe that some of the best oil and gas traders and the best intelligence is at those firms. They just really do hire strong talent to make sure to keep that price within a range of what absolutely hits their break even and profitability. Right now, because there's so much volatility across the entire sector, I prefer looking at the names as dividend plays than I do for the equity pop, even though I do actually think more than one of them, if not the majority of them, are massively undervalued by any basis because so many of them got clobbered during the initial impact of COVID when energy prices went, let's call it negative, to be honest. And then they came out of it swinging like champs and made that first section back such that they paid down massive amounts of debt. Okay, cool. Thank you. I'm definitely going to look at both of those, Pat. So thank you for sharing those with me. I feel like way back in the day, EQT was a bit bigger in size and I used to have to look at it on the regular, but so it's been a while since it's been on my radar screen. But yeah, so a lot of oil and gas got clobbered in a way that does not make any sense. And in some cases, like with Coterra, it does have like a 10% dividend yield. And there's nothing that would ever, even if the equity continues to decrease in value, there's nothing to stop that dividend yield because the US companies just refuse. I mean, to bring an entire industry before Congress and tell them to make less oil, and then literally 2 years later to bring them before Congress yelling at them because they didn't make enough oil, makes all of those energy executives very sensitive to overproducing. And I just don't think that Europe did what it needed to do in any way, shape, or form to shore up any form of energy, period. Not the least of which is the silliness going on with turning off your nuclear power plants, even though they are some of the youngest nuclear power plants over in Germany. So you're going to have to get that energy one way or the other. Now, originally, I was very bullish coal. I took and Consol Energy is my favorite one to play because of its location, quite frankly. But the real issue for me with coal right this minute, and I'll probably have a different opinion once the rail companies just tell me how much coal got transported, is that we still have rail issues that sometimes from time to time mess that up. Now, Consol I like a little better because they don't have like the CEO that got put in place for that particular turnaround when coal got clobbered. Yeah, Peabody is a great one. Okay, so Peabody versus Consol. Consol, as a part of its turnaround, they basically built out that railway that goes from the Appalachian coal area, because thermal coal is in that kind of the northern part of the Appalachian. So they built that railway out to make sure that that is in good shape. Peabody's coal is located in the Wilmette Basin in the middle, like Colorado, Wyoming, like that whole area. think Wilmette is actually Wyoming. Anyways, there's a rail line that goes there, but that rail line did not get built out correctly. So what happens to Peabody and also Arch Coal, the three bigger producers in the U.S. That actually produce coal, they don't just do some other thing like own the land rights, etc. But the problem for them is their thermal coal is locked in the middle of the United States, and we got a rail problemo. So it really comes down to what's going on with the rails and whether or not they got it to the coasts to help the coast out. So, the center part of the United States, we have a bunch of raw materials, and then all our population in the U.S. is along the coast. And then from the coast, you get to ship it out. So as a function of that, Peabody, from time to time, I'll go there. I'm a little bit not sure whether or not to go there right this minute. I'll know as soon as the rail companies come out in the coming weeks. I believe next week you start to get the first ones reporting, and then you might have one that reports the following week. The lines that go there are really oddly enough, it's actually BNSF is one of the major lines that will deliver across from Peabody, but you also have CSX, which probably does a little bit better, and then Norfolk Southern that brings it south. So it's really all three of the rail lines, and you really only have one rail line that is behaving in a way that makes it a little bit easier for Peabody. Nonetheless, until this whole situation gets sorted in Europe, coal, there's a cap on how low coal can go. And Console, I love listening to that call because he does such a good job describing. He doesn't have as much of the other stuff going on, let's call it that way. So he doesn't have a rail problem getting it to the shore. Nonetheless, the thing that he talked about and was talking about, I believe is true of the other coal companies, is that because we keep shipping it overseas, the utilities companies are a little freaked out as well, and they just want to. So most of the coal that got sold in the last few quarters wasn't to support Europe; it was actually to just shore up any potential problems that we had on our own electricity grid here in the U.S. What's that, David? Was there a question?
Oh, sorry about that.
Oh, no problem. That was on Peabody, and so that's Peabody on the coal front. Are there any other questions that you're seeing, or any other questions from you guys? Okay. I hope that was really helpful. Good luck. Next week really has about 3 times the number of companies reporting earnings. So I think really between today and tomorrow, you're going to want to just kind of hedge out if you are uncertain, or take opportunities where you are. But it is going to be kind of a wild ride for the next 2 weeks, because anyone that's got a strong economic opinion, either they're right or they're wrong, and we're about to find out. So have an awesome